Welcome to the Deep Dive. You've probably noticed the recent ups and downs in the stock market, particularly with the Nasdaq. It's been quite a ride.
It really has. And today we're going to try and make sense of some of that volatility.
We are. We've been looking at an article from the Motley Fool that, well, it digs into this volatility and tries to pinpoint not just what's happening, but maybe what opportunities might be emerging.
Right. Opportunities for investors like you listening.
So our goal in this deep dive is, first, to understand why we're seeing these big swings in the Nasdaq. Second, why the article suggests this period might actually be, a good time to consider investing.
And third,
what makes the three specific companies they focus on, Alphabet, ASTRAZENECA, and The Trade Desk, potentially very strong long-term investments.
Think of this as us trying to cut through some of the noise, give you the key insights from the source.
Exactly.
And it's important to put the recent market activity into perspective. I mean, the article highlights that the Nasdaq has seen 3 of its 5 largest single session point drops in history just recently.
Just recently?
Yeah.
Like this month?
Yeah. All within a single week, this April 3rd, 4th, and 10th specifically. It even briefly touched bear market territory.
Wow. And that's that 20% drop from the high. Right?
That's the one. A 20% or greater drop from a recent high. Definitely gets your attention.
It certainly does. But the article also provides some historical context, doesn't it? Pointing out that these kinds of bear markets have often presented really good opportunities.
For investors focused on the long game, yeah, that historical perspective is, well, I think it's really valuable.
Because short-term drops feel scary, but history suggests they can set the stage for growth later on.
Precisely. Often they have.
What's also worth considering is just how much more accessible investing has become.
Oh, absolutely. The article mentions the shift to commission-free trading, no minimum deposits.
Right. So even starting with a relatively small amount, like the article throws out $300 as an example, it can be a way to get started.
It lowers the barrier significantly.
Okay, so let's get into it. What's been the spark for all this recent market volatility? The article points a finger at President Trump's Liberation Day tariffs.
Yes, it identifies those tariffs as a significant factor contributing to this wild volatility, as they call it.
It seems like they introduced a lot of uncertainty.
They did. And as the article points out, we then saw this really sharp whipsaw effect.
It was pretty dramatic. April 9th, the Dow, the S&P 500, the Nasdaq all had their largest single session point gains ever.
Huge gains, yeah. And
the very next day, April 10th, the Nasdaq just tanks, one of its biggest single-day point declines.
That kind of dramatic back and forth, that whipsaw, can really shake investor confidence.
For sure. It highlights how sensitive the market can be to news, to policy changes.
Definitely. But, beyond the immediate impact of tariffs, the article also brings up another important underlying issue.
Which is?
The fact that, historically speaking, stocks have been quite pricey. That's a quote from the piece. Okay, so high valuations. That makes sense. If stocks are already expensive, negative news can trigger a bigger sell-off.
Exactly. Investors get more cautious, maybe quicker to sell.
And there was something else adding to the mix, wasn't there? Some economic forecast.
Yes, adding to that overall picture, the article mentions a forecast from the Atlanta Federal Reserve's GDP Now model. This is from April 9th.
And what did it show?
Well, it projected a potentially significant contraction in U.S. first quarter GDP. Now, if you exclude those, unusual pandemic quarters,
right,
a contraction of the size they projected would be the worst we've seen since the Great Recession.
Okay, wow. So that naturally raises concerns about a possible recession.
It certainly does. Adds another layer of worry for investors.
So, okay, we've got tariffs creating uncertainty, potentially high stock valuations, and these growing worries about the broader economy. That paints a clearer picture of the volatility.
Especially in the Nasdaq, which is heavy on growth and tech stocks that can be more sensitive to these things. Right. Okay, let's dive into the first company the article highlights as a potential buy during this time. Alphabet, GOGL, parent company of Google, YouTube.
Google Cloud too. So in this context, this turbulent market, what's the main worry for a giant like Alphabet?
Well, the article points out the obvious connection to the economy, advertising spend.
Right. The possibility that a recession could lead businesses to cut back on their advertising budgets.
And that's a big deal for Alphabet because
it is a huge chunk of their revenue. The article says around 75% in the fourth quarter comes from advertising. Google search, YouTube ads, etc.
That's definitely a valid concern. When things look cloudy economically, marketing budgets often get squeezed.
They do. It's often seen as discretionary spending, at least in part.
But the article also mentions a potential silver lining here. What's the counterargument?
The key counterargument is history, really, looking at U.S. recessions.
Yeah.
They tend to be shorter, historically, compared to periods of economic expansion. The article notes the average recession since World War II lasted about 10 months.
Okay, less than a year on average.
Whereas expansions have typically gone on for around 5 years. So the suggestion is that any big dip in Alphabet's ad revenue might be relatively temporary.
That longer-term view is important. And what about Google's position in its core market? Search.
Oh, that's a massive advantage. Google has just consistently dominated global search. Market share between, 89% and 93% for over a decade now.
That's incredible dominance.
It really is, and it gives them significant leverage, right? Pricing power for their ads. Even if overall spending dips, their position likely helps them maintain a strong revenue base.
Okay, makes sense. Now, beyond advertising, the article also talks about Google Cloud. What's the story there?
Google Cloud is presented as a really key growth area. It's number 3 in cloud infrastructure. But that whole market is still seen as having a long runway for growth.
And there's an AI angle, too.
Yes, exactly. The potential for integrating generative AI solutions could really accelerate the already strong, double-digit growth in that cloud segment. Plus, cloud tends to have higher profit margins.
Right, higher margins are always good.
Yeah.
And Alphabet's financials, they're sitting on a lot of cash, aren't they?
They are. The article mentions $95.7 billion in cash at the end of 2024.
$95 billion. So that gives them options.
It's a lot of flexibility, yeah. They can invest aggressively in those growth areas like cloud and AI. And importantly,
Buybacks.
buy back their own shares, yes, which reduces the number of shares out there, potentially boosting earnings per share, the EPS, makes the stock look more attractive fundamentally.
So putting it all together, the ad concerns, the historical view, the search dominance, cloud growth, cash pile, why does the article see it as a compelling buy now?
It really seems to hinge on the valuation.
Okay.
The argument is that Alphabet stock hasn't been this inexpensive based on its expected future earnings. It's trading at around 15 times the consensus earnings per share expected for 2026.
So historically cheap relative to future potential.
That's the case being made. Given everything else, market position, growth, financials, this valuation, combined with the recent dip, is presented as a really interesting opportunity. A no-brainer buy, I think was the phrase used.
Strong words. Though you always have to wonder if those future earnings estimates fully bake in, say, a longer advertising slowdown or maybe more regulatory heat, right?
That's always the caveat, isn't it? Projections are projections, but based on the analysis presented, it looks attractive.
Okay, let's shift gears. Second stock, ASTRAZENECA, ticker AZN, big pharmaceutical company. How does this one fit into the picture?
Well, it's quite different from Alphabet, obviously. Different sector, different dynamics.
So what are the specific concerns raised for a pharma company like AstraZeneca during this kind of uncertainty?
The main one mentioned in the article, specifically tied to recent events, is again the potential for tariffs. Tariffs on pharmaceutical products.
So trade policy worries again.
Yeah. The article notes President Trump's stance on tariffs has varied, but if pharmaceuticals were hit, it could definitely put pressure on their profit margins.
Got it. But healthcare stocks often have a reputation for something else, especially when the economy looks shaky.
Exactly. Their defensive nature. Healthcare is generally considered a very defensive sector.
Meaning?
Meaning demand for essential goods and services, like medicine, tends to remain relatively stable, regardless of what the broader economy or the stock market is doing.
Right. People need their prescriptions whether things are beaming or busting.
Pretty much. It provides a certain level of resilience for these companies.
That makes perfect sense. So how has AstraZeneca actually been performing? The article seemed quite positive on their recent growth.
It did. It highlighted really strong growth across all of its main business areas in 2024, looking at constant currency sales growth.
Constant currency, meaning they adjust for exchange rate swings.
Exactly. So you see the underlying business performance.
Yeah.
And the numbers were impressive. Oncology, the biggest area, grew 24%.
24%, wow.
Cardiovascular, renal, and metabolism CVRM that grew 20%. Respiratory and immunology, 25%. Even their rare disease segment saw 16% growth.
So strong growth pretty much across the board.
Yeah, widespread strength. Indicates a healthy business.
The article also mentioned a big acquisition they made a few years back, Alexion Pharmaceuticals.
Yes, the 2021 acquisition of Alexion. That's seen as a really strategic move.
Why is that?
Because Alexion brought in a portfolio focused on rare diseases. These therapies often face less competition, and they tend to have better pricing power with insurers.
Less competition, better pricing. Sounds good.
And notably, Alexion developed Ultomiris, which is a newer version of its blockbuster drug, Soliris. That helps secure revenue streams with less worry about generic competition coming soon.
Okay. Strengthens their long-term pipeline. Are there other positive trends helping them?
The article points to one specific thing: earlier detection and screening for cancers.
So better diagnostics are increasing demand.
That seems to be the case, yeah. Boosting demand for their key oncology products. It's a positive driver.
And finally, just like with Alphabet, the article suggests AstraZeneca's current valuation looks attractive too.
That's the argument. It highlights the stock trading at less than 11 times its projected earnings per share for 2026.
Less than 11 times 2026 earnings. That does sound relatively low, especially for pharma.
It does. So combine that valuation with its defensive qualities, the strong growth across the board, the strategic boost from Alexion. The article makes a case for it being a compelling investment to consider right now.
Okay, interesting. That brings us to the third and final company the article spotlights, the Trade Desk, ticker TTD, ad tech industry.
Right. Operates what's called a demand-side platform, helps advertisers buy digital ad space.
So we talked about advertising concerns with Alphabet. I assume similar worries apply here.
Yes, very similar headwinds. The Trade Desk revenue is entirely dependent on advertising spending. So, yeah, worries about tariffs, market volatility, recession fears, all could lead businesses to cut marketing budgets.
And the article acknowledges a recession would likely hurt the ad industry.
It does. It acknowledges that potential negative impact.
However, there's always a however, isn't there?
Often is. In this case, the article notes that the Trade Desk's stock price had already fallen quite sharply before this recent bout of volatility really hit hard.
So maybe some of the bad news was already priced in.
That seems to be the suggestion. The article mentions a roughly 2/3 drop in the share price since its peak late last year, suggesting that maybe a lot of the recession risk is already reflected in the current price.
Okay, so looking beyond the immediate economic jitters, what's the long-term growth story for the Trade Desk?
The big picture is the massive shift towards digital advertising. It's just growing much faster than traditional channels like print or linear TV.
And the Trade Desk is positioned to benefit from that shift.
Very much so, according to the article. It expects the Trade Desk to be a major beneficiary, especially in the rapid growth area of advertising on connected TV platforms, streaming services.
Right, streaming is huge.
Yeah.
The article also mentions some specific tech they have, Unified ID 2.0.
Yes, UID 2. That's presented as a really crucial piece of technology for them.
Why is it so important?
Well, it's basically designed as a replacement for the traditional third-party cookies that websites use to track users.
Which are kind of going away due to privacy concerns, right?
Exactly. UID 2 offers a way for advertisers to still target consumers effectively, especially in that growing streaming world, but in a way that's designed to be more privacy conscious. Its adoption is seen as a big plus for the Trade Desk.
Okay, so it helps them navigate the changing privacy landscape. And that term demand-side platform, what exactly is that again?
Right, good question. It's essentially a technology platform that lets advertisers and ad agencies programmatically buy ad inventory across lots of different digital channels, websites, apps, streaming services, etc., all in one place.
Got it. So it automates and optimizes the ad buying process for the advertiser.
Precisely.
Okay, so finally, what about growth expectations and valuation for the Trade Desk?
The article projects strong revenue growth still, around 20% annually for the foreseeable future.
20% annual growth is pretty significant.
It is, and despite that, the stock is currently valued at what the article describes as a historically low multiple 22 times its forward-year earnings per share.
22 times forward earnings for 20% growth.
Yeah, that combination, strong growth potential, a valuation that's seen as relatively attractive compared to its history, is why the article views the current downturn as a potentially compelling buying opportunity for TTD.
Okay, so we've looked at the overall market picture and dug into Alphabet, AstraZeneca, and the Trade Desk based on this Motley Fool analysis. Bringing it all together, what are the main things our listeners should take away from this deep dive?
I think the biggest takeaway, maybe the core message, is that even when the market feels uncertain, even during downturns, opportunities can pop up.
Opportunities to invest in companies that are fundamentally strong.
Exactly. It's about trying to look past the day-to-day noise, the short-term jitters, and focusing on businesses that seem to have real competitive advantages and good long-term growth prospects.
Right. The article really emphasized those underlying strengths. Alphabet's search dominance and cloud growth, AstraZeneca's defensive sector and drug pipeline, the trade desk's position in digital advertising.
And it highlights that difference between sort of short-term market swings and maybe longer-term economic or industry trends. Volatility can be unsettling for sure, but the long-term potential for these kinds of companies, as outlined in the article, might still be quite promising.
And valuation is clearly a key piece of this puzzle. The argument running through the analysis of all three stocks was that they look attractively priced now, relative to their future potential.
That's right, which could make them potentially resilient even if the market stays choppy for a while. It's that idea of buying quality businesses when they're on sale, essentially.
A classic investment principle.
It is a reminder that market dips can be seen as opportunities, not just threats, if you have that long-term perspective.
So as we wrap up this deep dive, we've explored the recent Nasdaq volatility, put it in some historical context suggesting potential opportunity, and examined the specific arguments from the Motley Fool for considering Alphabet, AstraZeneca, and the trade desk right now.
Yeah, we looked at the potential reasons for the downturn, but also the potential resilience factors for these specific companies, their business models, their market positions, their growth areas.
And we touched on that idea that even with a relatively modest amount, like the $300 mentioned, you can potentially start investing in these kinds of leading companies.
Which is quite empowering, I think. It encourages you, the listener, to maybe think about which aspects of these businesses resonate most with you. Is it the resilience, the growth, the tech?
And perhaps the final thought, the thing to maybe mull over on your own, is what further research you might want to do.
Exactly. To feel more confident understanding these potential opportunities in this market, this article, this discussion, it's really just a starting point, right?
A foundation for your own exploration.